Hi everybody, and welcome back to video 2 on chapter 2. We were working on revenues at this point in time. So this time we're going to provide our services not for cash, but on account, as it's called, or sometimes on credit. So we expect to be receiving money from our customers. So this is going to be, our accounts are going to be a increase in accounts receivable of $2,000, and our revenues are going to increase. We call that service revenue by $2,000. That does increase the accounting equation to $43,600. So in transaction 6, we're going to receive cash in advance from a customer. So in this case, if we're receiving cash in advance, we are going to get cash, so cash is going to go up, but we call that deferred revenue, sometimes referred to as unearned revenue, because we haven't earned the revenue. So don't get deceived by this title, revenue. This is a liability, because we have not yet earned that revenue. On the income statement, we only show revenue when it's earned, and for that matter, expenses when they are incurred. So, in this case, cash is going up, deferred or unearned revenue is going up as well. And as it says here, don't let that name fool you. The term revenue is not a revenue account. It's a liability account. And it indicates the company has not yet provided those services, even though it's collected the customer's cash. We have a liability to perform those services. All right, now we're going to pay our salaries to our people. In this case, $2,800. So cash is going to go down to pay that, but our expenses, salaries expense, is going to go up. But when it comes over to stockholders' equity, it's going to reduce retained earnings. I know that's a little confusing. So yes, the expense is going up, but when it is subtracted from revenues, it reduces retained earnings. All right, in transaction 10, we pay cash dividends. Cash dividends lives only on the statement of retained earnings. It's not an income statement account. So in this case, cash is going to go down, and dividends is also going to reduce retained earnings. Just like an expense would reduce retained earnings, but it's not an expense. Okay, so now if I look at all the summaries of those 10 transactions, you'll see that the accounting equation remains intact. Now, we'll do a little concept check. What effect does the payment of dividends have on the accounting equation? Well, if you answered bravo, assets decrease and equity decreases. The asset is cash, that's decreasing, and in equity, it's retained earnings that's decreasing as well. Okay. All right, now on to debits and credits. Hopefully you've been doing that introductory video before you've got to this part on debits and credits, so you have some working knowledge with debits and credits, where accounts live, how we do that. So let's look in a little more depth. We're assessing whether the impact of these external transactions are going to result on a debit or credit on the balance sheet. So here, the left side is our assets, and that increases with a debit. So the only one you really need to remember is that debits increase the left. So that means credits decrease the left. It's the opposite on the right-hand side. Debits are going to reduce liabilities or reduce stockholders' equity, and credits will increase liabilities and stockholders' equity. Okay, you have to have this absolutely down. This is fundamental for doing well in this course. All right, so here we have the effect on the accounting equation and the effect on the expanded accounting equation. Okay, if you like memory aids, DLOR is one way to do that. We have dividends, expenses, and assets on the left-hand side. We have liabilities, owners, or stockholders' equity on the right-hand side, and revenue. We use owner's equity, by the way, if we're dealing with a sole proprietor or a partnership. We use stockholders' equity if we're dealing with a corporation. So what does the word debit mean? I'm going to tell you everything you ever need to know about the meaning of the word debit. It means left. That's all. Don't think that it means anything more than that. Sometimes debits increase an account, sometimes debits decrease an account. Now you'll never guess what a credit does. A credit is on the right. That's it. The meaning of credit. Don't think it means anything more than that. Sometimes credits increase an account, like you might think, but also sometimes credits decrease account, depending on if they live on the left or the right-hand side. All right. So here's our fundamental, this would be a fundamental format for recording a journal entry. We'll have the debit first, and Connect will mark you wrong if you don't put the debit first. So get in the habit of doing the debit first. And then we indent the credit. Okay, just like it's shown there. And we usually have a description of that transaction as well. So we call it a journal entry. We're good with that? Okay. So now we'll go back to those original 10 transactions and look at the effect they have on debits and credits. The first transaction is when we sold some common stock. So cash went up, common stock went up. Cash lives on the left-hand side as a current asset. Common stock lives on the right-hand side as an stockholders' equity account. So we're going to debit cash to make it get bigger because it lives on the left. We debit left-hand side accounts to make them get bigger. And common stock is on the right-hand side. We're going to credit that to make it get bigger. So don't forget to indent the credit names. That's fine. Sometimes, as I say, there's more than one debit or more than one credit. Be sure to indent both of them. Or be sure to indent the credit one. All right. Now, once you've done all the journal entries, we're going to post that to the general ledger. The general ledger is where we keep an accounting of the running balance in every account. Posting is the process of transferring the debit and credit information from the journal to the general ledger account. So the general ledger then provides a single collection, each account with an individual transaction and resulting account balances. So here is a simplistic version of a general ledger account. All right, so our first transaction here, we're going to post that to the general ledger. And as you see, we have the first tan block there says cash, and the second one says common stock. Here we debit or increase cash, and the balance, the running balance, is $25,000. We do the same thing for common stock. Now we're going to post the next transaction, which is borrowing cash from a bank for $10,000. You remember cash went up, notes payable went up. So we're debiting cash, left-hand side account, crediting notes payable to make a right-hand side account get bigger, and we post those to the general ledger cash account and the notes payable account. Okay, now we have running balances for each one of those accounts. Next, we purchase some equipment with cash. Equipment went up, cash went down. Both are left-hand side accounts. Cash is a current asset, while equipment is a long-term asset, sometimes called fixed asset or plant asset. But they're both assets. They both live on the left-hand side. To make them get bigger, we debit them. Cash went down, so we credited that left-hand side account to make it get smaller. And as it's shown, the balance of cash now is down to $11,000. On December the 1st, now Eagle pays 1 year of rent in advance. So the asset prepaid rent goes up, the asset cash goes down. Both left-hand side accounts. So we'll debit prepaid rent and credit cash. Starting to get the hang of how to do this. Takes a lot of practice to be able to do this quickly and efficiently. So please put in that practice time. You're going to be so glad you did. All right, now we're going to post, we purchased some supplies on account here for $2,300. So in this case, supplies is an asset, a current asset. We're going to debit it to make it get bigger. And accounts payable, a right-hand side account in the liabilities section, is going up as well. We'll credit a right-hand side account to make it get bigger. We'll post them to the tan block representing the general ledger. Now we're going to provide our soccer training to our customers for cash this time. So the asset cash is going to go up. Cash is a current asset. Service revenue is a revenue account on the income statement. And when it comes over to the statement of retained earnings, it increases that statement of retained earnings. And that is shown here by this plus to revenue and plus to stockholders' equity here. And so we're crediting both the revenue to make it get bigger, the only thing that lives on the right-hand side of the income statement, and stockholders' equity eventually when we do the closing entries. Okay, I think this represents a good place for us to stop this video, and when we continue, we will start with posting this 7th transaction. Bye for now.